One of the things that was interesting to me was this term that you used, an urban doom loop. Describe to us, what is that?
Well, it's essentially a vicious cycle. And it starts with declines in commercial property value, which affect the tax base, because a lot of taxes that cities collect come from real estate. And as those tax revenues dry up, the city has to balance its budget either by raising taxes on other things, on businesses, on people, or by cutting expenditures. But that means cuts in government services, less money for transportation, for sanitation, for education, right? All of which is locally funded, all of which then reduces the quality of life in the city. And then some people will decide that this is not the place for them to be anymore, either because the services are not what they used to be or because the taxes have gone up, and they will leave. And, them leaving means that there's less money coming in now from, property taxes, from sales taxes, from income taxes, and so forth. And so the situation gets worse. And it's this type of dynamic where we see people leaving cities, tax revenues drying up, cities getting into fiscal trouble. That is what the urban doom loop is about.
I think that might be, I understand what you said, I understand that, but I'm not sure where you're getting these statistics, because I know we're all in a post-COVID era. But even before COVID, there was something called hoteling with these offices. So people were not necessarily coming to the office. I just don't know where these statistics come from, where they're building this vacancy norm from. To me, it seems like people are coming back to work Tuesday, Wednesday, Thursday, and they're there those 3 days, which swells them needing these offices all the time. So even though they are not back to work like they used to be, the days that they're there, Tuesday, Wednesday, Thursday, makes it busier than as if they were there 5 days. So I'm curious to where people are getting these statistics that it's all empty, and where's this coming from?
Yeah, so let's start at the start. So let's first of all distinguish between contractual vacancy and actual physical vacancy, right? I think you're talking about physical vacancy. How often are people actually coming in? We now have a lot better data than we used to about that. And we, for example, have turnstile data where every time you walk into your office, you swipe your badge and you get counted. And we have daily statistics on that. And we've been keeping track of that since at least 2017, 2018. And what we see in those numbers is that the actual people coming into the office are coming in at roughly half the rate that they were coming in before COVID. Right. So you're right that nobody was coming in not everybody was coming in all the time, even before COVID. Let's say that, about 60% of offices were actually physically occupied before COVID. Today, that's 30%, right? So it's half the level it used to be. And you're right, it's a little bit higher on Tuesday, Wednesday, Thursday than it is on Monday and Friday.
I think it's a lot higher.
And again, we know that because we could track these daily. I think it's probably 25% of pre-COVID levels on Fridays. It's 55, maybe 60, maybe 65% of pre-COVID levels on Wednesdays. But nevertheless, even on the best of days, it's substantially below what it used to be.
Got it. So I'm unclear about how people are really measuring that, because I've researched this, and it seems to me that this amount of space that's needed, because there's so much people that have to come back to work and they're working the 3 days, the companies will still need the space. Maybe I'm being optimistic, but that's how I have seen it, and that's what my commercial friends and clients have told me. But we could move on.
And the other thing we need to be cognizant of is, and again, it's not a huge share of firms, but there are firms, and a lot of firms that were started during the pandemic were started as remote only companies. Right. So we have about, let's call it 10% of jobs that are fully remote, right? So these companies create jobs, but they don't need offices.
I see. So the other thing, I was listening to what we were talking about, this whole bank situation and where we are right now, which we're going to get into it. But do you think that a big part of this is because of interest rates, but also because during the last few years, right before COVID, a lot of these landlords, rather than selling their buildings, they took their money out, they refinanced. Now the banks are left with this at a higher, and they can't pay the new rate. They have to restructure, and it's like the game tag where whoever's going to be left less.
Yeah. So when we think about sort of the impact on values, on office values, right, that certainly plays an important role. The fact that now these values are lower because, first of all, sort of the cash flows are lower because of the structural issues that we talked about, just less demand for office. But then, sort of the issue usually comes to a head when the debt needs to be refinanced, right? So a lot of debt in commercial real estate is fixed rate debt. Let's call it 10-year fixed rate debt. When those 10 years are up, you typically haven't paid a whole lot of principal down, so you have to refinance the entire loan or most of the loan. Interest rates are, a full 200 or 300 basis points higher than they were 10 years ago. So that interest expense is going to go way up. And many times the cash flows are not there to cover that interest anymore. And so now the banks, if they're willing to give you a new loan at all, they're going to give you a loan that's much smaller than the one that you need to refinance. And so now you have a tough choice to make as an owner. Either you come out of pocket for the difference and put in new equity into the building, or you walk away. And a lot of owners, I think, maybe correctly see that there's sort of structurally less demand for their product, and they're going to decide to walk. There are other buildings. Not all buildings are created equal. There are other buildings that are doing well, and those owners are going to reinvest in those properties, and those properties will flourish. So we'll have some of each. We'll have sort of a real bifurcation in the market going on.
So some of those other buildings are what you call a flight to quality. And those are trophy buildings, such as like One Vanderbilt, some like this 60 Hudson, 30 Hudson, all these locations where you have trophy buildings. And they have all these wonderful amenities. Do you think in these trophy buildings, do you think it's location that's attracting these higher rents? I mean, I'm reading some of these rents on a low floor up to $100 a square foot, high floor $250 a square foot. That's more than pre-COVID. Do you think it's because of location, because it's easily near transportation, or because of all these wonderful amenities?
Yeah, I think, look, it's the best versus the rest in the office market right now. And the best is really a combination of excellent location, close to transit, for example, right? So that the folks that did move to the suburbs during COVID can actually come in easily. So close to major transportation hubs, be it Penn Station, Grand Central, Hudson Yards, right? And amenities, celebrity chefs, the idea that you need to earn the commute of your workers. You got to lure them into the office. You got to keep them happy while they're there. And I think it's that combination.
But do you think, let's say I built a building, in the financial district or Battery Park, which is a good example because that's far away, with wonderful amenities, but it wasn't close to transportation, but it was beautiful, it was glitzy, it had childcare, it had health care, it had a cafeteria. Would that still get me $300 a foot or $250 a foot, or is it really the location?
Probably not. That building might still do well. There's probably room for trophy buildings downtown, right? Think about the World Trade Center.
Right.
That's class A plus. That's trophy, beautiful office space. But I think it's true that vacancies are a little bit higher downtown, and that you do not have that same proximity to fantastic transportation.
Stan, one of the things that everybody is talking about, which is a big issue. Every city needs infrastructure. We need teachers. We need police officers. We need sanitation. There's no housing for these people. There's no city that's going to do well without that middle the middle person getting homes. So I don't really want to call it affordable housing, but I want to call it middle income housing. What do you think would be the best model to create that so that the cities could sustain itself and have those type of housing for those type of people?
Now, that's a really hard question, right? Because land is very expensive in New York City, and it's hard enough to build regular rental housing. It's even harder to build affordable housing. The only way we've been able to do this in New York City for the longest time is with subsidies. For example, the 421A program, which went away a couple of years ago. And in fact, the lawmakers in Albany are debating a new program this very moment. I'm very hopeful that some new program will come to the fore.
Me too.
Because without that, I think it'll be really hard to build. Because at the end of the day, we have just a huge housing shortage in New York City. And any sort of housing will help with affordability, right? Even if it's luxury housing, it will help because it will free up an apartment. Somebody will move into that will free up another apartment. Somebody will move into that apartment. And at the end of that chain, there's an affordable apartment becoming available for a teacher or a police officer. So I think we got to keep an open mind. We got to build more housing first and foremost, and then maybe there's some other things we could think about, some additional programs where we give a housing allowance to some of these essential workers. Maybe that's just part of their compensation package.
I like that. So what do you think we should do with all this Class B office space. How are we going to maintain a healthy tax base for the city with all these B buildings that are not doing well? It really comes down to taxes and services.
Absolutely, right? So I think it's we have, just to put it in context, we have about 95 million square feet of office that's currently vacant or
on the B buildings,
or subleased in general, no in total.
In general, okay.
A good chunk of that is in B and C, where the problem is much more severe than in A-class buildings, right? And I think the right answer is we need an all of the above approach, which means we're going to need to convert some of that Class B office into Class A plus office. We're going to need to convert some of that into industrial, life science, lab space, healthcare space, higher ed, childcare, maybe, urban farms for all I care, right? Entertainment facilities. And then that's sort of approach 2. And then approach 3 is we need to convert some of it into housing, because to our earlier conversation, we're lacking housing in the city. And in particular, there's a lot of young people that want to live here. Some of these buildings, these larger office buildings in particular, are more amenable to sort of co-living setups where maybe you have sort of 6 people living in an apartment suite, if you like, where each one has their own bedroom.
WeWorks tried that; it didn't work very well.
I think we need sort of modern versions of single room occupancy. I think we need to keep an open mind and use these buildings as best as possible. And it's my conviction that there's at least let's call it 20. If we're really lucky, 30% of office buildings are convertible into residential, right? So that's a non-trivial amount. It's not true that every office building can be converted into residential at all, but there are some, and it's happening, right? Just today, there was a big announcement that 222 Broadway is going to get converted by GFP. They're also doing a conversion on 25 Water Street. They're also bought the Flatiron building for a residential conversion. So there are buildings that can be converted, and we need to make sure that those projects are successful. That means streamline the approval processes, make the zoning flexible, and hopefully there'll be sort of potentially a tax incentive, especially when it comes to creating some affordable units in those buildings.
So we all know the difficulties in converting, the water, the elevators, all of that, we get it. But if you're able to get through the permits and do all that, Stan, what does that do to the tax basis? How is it retaxed now? Because now it was commercial and now it's residential. How will the city pay? What will happen with that?
Well, so it's true that the tax rates on a residential building in New York City today are a little bit lower than on a commercial building. But I think that's the wrong comparison, because that office building, if it's 30% occupied today, is doing very poorly, and it's not viable as an office building. And over time, its value is going to go down.
But the tax is still being paid.
But the tax eventually, as the NOI on those type of buildings goes down, the taxes will also come down on that building. So the city is looking at a declining tax revenue from those office buildings. Can it do better with a brand new apartment building? Yes, it can. In terms of total tax collected, I believe it can do better than with a defunct office building.
Have you seen many of these buildings be torn down? Like, I see some of these buildings on Park Avenue. I'm thinking, like, maybe they're just going to take them down and build a beautiful high-rise. Are you seeing that?
Some of that will have to happen through demolition. I think some of these buildings are sort of not amenable. They were not built for, let's say, residential living. And the best option might be to, start over and build a multifamily tower on that lot. So I think, again, that's sort of the fourth component of the approach, of the all of the above approach. Some of it will have to happen through demolition. I will say, whenever possible, I think conversion has the added benefit of, capturing some of that carbon that was already spent on steel and all the things that went into that building, rather than having to start all over. But sometimes it's just not effective and not efficient, and we should, gotta make decisions that make business sense.
Let's move over to the debt side, which is what you spoke about on the show. Are we looking at another potential banking crisis like we did in 2008 because of the commercial real estate situation?
I do not think so. Now, that's not to say that there are no issues with these commercial real estate loans. I think that sort of there's not enough of that commercial real estate debt out there to bring down the banking system in the United States.
Good news, everybody. That's good.
So that's great. And part of that is because a lot of these commercial real estate loans are sitting on smaller banks' balance sheet, right? So there's about $6 trillion of commercial real estate debt in the U.S. About half of that sits on banks' balance sheets. And of that $3 trillion that sits on banks' balance sheets, about 70% sits on smaller and regional banks'
Like
balance
Signature
sheets.
and these banks that went under.
Yes, correct. Those are on the larger end of that
Really?
group of banks. Okay, so our very largest banks, Citi, J.P. Morgan, Bank of America, they all have fairly minor exposure to commercial real estate. They do tend to have exposure in the urban cities to the largest assets, but as a share of their book of business is not that much. It's like 4, 5, 10%, right? Something on that order.
That's really good news.
Whereas for some of these smaller banks, they do have 30, 40, 50% of their loans in commercial real estate. So do I believe that some banks could fail over this? Absolutely. But these are not the systemically risky banks. Do I believe that we could have 200 or 300 banks fail in the United States over this? I do. But again, that's not a systemic crisis because we have 5,000 banks in the United States. If there's 300 of them, 300 small banks that fail, it's not the end of the world. We can manage through that. And banks are, trying to provision for these losses. They have seen these losses coming for a number of years now. They are saving their way out of it. They are going to have to write down some of that debt. But as long as they're well capitalized, again, we can manage this. So unless there's sort of an additional big shock that hits the banking system simultaneously, I do not think CRE by itself will be like a problem that we cannot manage through.
How long can they pretend and extend? These loans are coming due. They push it forward. They push it forward. Everybody I talk to says, yeah, I'm in the banking business, but we're not writing it down yet. The banks don't want it. The landlords don't want it. They're just pushing the can forward. How long can that go on?
Well, look, the banks don't want to own these buildings because they're not in the property management business. And, as long as you have a landlord that is willing to work with you, that is potentially able to put in some new equity, maybe some tenant improvements, to bring in a new tenant, that's always going to be the bank's first choice. Now, some owners, don't want to throw good money after bad. And so they just have decided that it's no longer worth it to invest in that asset and they're going to walk away, right? So at that point, the bank is going to have to write that loan down and sell off that asset to somebody else. And I think the good news at that point is we have the silver lining is now the losses have been realized. Now the basis of that asset has been reset to something much, much lower. And it's that low basis that now allows for that asset to get converted into something else, to get reimagined, right? We sort of have to go through that process of renewal.
Resetting.
And unfortunately, whenever you have a reset like that, somebody needs to lose their shirt. In this case, it's the landlord in the first, who takes the first loss, and then it's the lender who's going to have to take some losses as well, right? To give you a statistic, last year, only 1/3 of loans that came up for pay down on their maturity date paid off. 1/3 was extended.
Wow.
And 1/3 defaulted, right? So that 1/3 that extended, how long can it go for? Typically, the extensions are 2 years, 2 one-year extension options. And so everybody's sort of betting that 2 years from now, interest rates will be lower or somehow people will be back in their offices or some other economic miracle will have happened.
A lot of loans are become due in 2 years. I think the numbers are staggering. What are the numbers on that?
Yeah, so, look, we have, even without all these extensions, about $500 billion coming due in each of the next 5 years. So there's already a lot of debt coming due anyway. So now we're going to essentially take some of that and push it out 1 or 2 years. So, 2026, 2027 are going to be pretty critical years.
Stan, can you just take us through the process for the average person? A lot of people that are listening to our show, they don't understand the terms. So the bank takes it back. We understand common sense. The building is restructured. The landlord has no tenant. Then the bank takes it back. What does the bank do with those losses? How does that affect the cities and the average person?
Well, so once that loss is realized, then essentially that and let's say somebody else buys that building from the bank.
Well, let's say they don't buy it.
If it sits on the bank's balance, first of all, the bank needs to write down that loan, right? When that loan goes bad, it needs to write it down. Mm-hmm. That means that the bank needs to spend some of its capital, loses some of its capital in that write down, and potentially might have to go back to the capital markets to recapitalize, right? Then the second thing is, once that asset gets if it lingers on the bank's balance sheet, it's called an REO, a real estate owned loan. Just like in the financial crisis, banks were sitting on tons of houses that were in foreclosure, but eventually that asset will be sold in a foreclosure process. Could take a long time. It takes about, on average 18 to 24 months for that whole process to play out, sometimes longer. And then eventually, when that asset gets sold, it's now worth a lot less. So the tax, now the city is going to take a hit on the taxes, right? Because that new owner is going to get a new tax assessment, which reflects
Exactly. That's my point.
That
What
new
happens
value.
to the cities? We start to lose services. We start to lose police. We start to lose libraries and anything where there's taxes are running a city, correct?
Exactly. So, I mean, we have about, $115 billion in New York City in tax revenues. Something like 15% of that is coming from commercial property, maybe a little less. 10% of that is coming from commercial property. So if we lose, let's say 30 or 40% of that, that's a meaningful hit. We could be losing, $4 or $5 billion in tax revenues, a few years down the line, sort of on top of the budget deficits that we're already staring in the face with, the expiration of all the federal help to cities, with the migrant crisis that a lot of cities are facing, right? Sort of even without additional revenue loss from property tax, New York City is looking at a $10 billion budget gap.
Did everybody hear that? It's $10 billion
so
budget
it's almost like 7-8% of our budget, which is a massive hole, right? And so, we gotta be proactive. And
what we have to do? We have to keep our cities safe. We have to keep our cities clean, and we have to have the proper politicians so that people will want to be in the city. Because if services will get cut and there's no budget, then who's going to want to live here?
Absolutely, right. And the truth is, we have already lost 500,000 people since COVID. The census just came out today with its new statistics. Last year, we lost another 80,000 people in New York City. So that cannot keep going because those are all taxpayers, right? And, you cannot afford to lose, that many taxpayers before you have an issue.
Well, we need good leaders, and I want to thank you for coming on the Miller Report. I hope everybody listens to this, and everybody's got to get out and vote if you want to keep the city vibrant. Here on the Miller Report, our goal is to take back our city, keep it vibrant, keep our taxes, and thank you so much for coming on the Miller Report.
Thank you, Suzanne.